Temporary buydowns. Have you heard of this option yet? This is one way for buyers to reduce their payment over the first 1 to 3 years of their home ownership. The short summary of this is it's a fixed rate loan, and your rate is reduced as much as 3% for the first year, then 2% for the second year, and then 1% the third year. And then going forward, it's a fixed rate for the remaining of your mortgage. We do need a plan for this though, as it can only be used if the seller is paying towards your costs. So we definitely need to discuss this prior to you making an offer. This is a very common program over the past few months as a way to combat today's higher interest rates.
The temporary interest rate buydown is a fixed rate loan, and it's really important to understand that this is very different from an adjustable rate loan. With a temporary rate buydown, the borrower knows exactly what the payments are going to be years 1, 2, 3, and all the way through 30. When we refer to a temporary rate buydown, there are some numbers at the front, and this is what they are referring to. So we might call it a 2-1 temporary buydown. The 2 references the first year. The 1 references the second year. So 2 means 2% off of the fixed rate, and 1% off the fixed rate. So, and that might not sound like a lot, but the monthly payment savings is actually pretty dramatic. Let me give you a couple of examples. So on a $300,000 loan whose permanent fixed rate is 6%, 2% off of that, which brings it down to 4%, has a payment that is $360 lower approximately. And then year 2, which is 1% lower, the payment is about $150 lower per month. And that varies based on what the long-term fixed rate is and what your loan amount is. Think in terms of your incomes. So is your income likely to increase enough to cover the difference between year 2 and year 1? So $300 a month means $3,600 a year. Is your income going to grow enough in order to cover that difference? Think in terms of after taxes. Let's talk about the pros and cons of the temporary interest rate buydown. The first one is obvious: reduce payments for the first 1 to 3 years, making it more comfortable for you. You actually have to qualify for the long-term rate, and think of that as a pro. As a mortgage lender, we qualify you based on the higher rate, so that we know that you're going to be capable of being able to handle the payment increases. Another pro is that it allows time for your income to grow in order to cover the monthly payments as they increase. The only real con that I can think of is that it requires the seller to fund it. So when you negotiate a contract, the seller has to agree to pay into your temporary subsidy account. It's seller paid closing costs, so you have to be able to negotiate with the seller to pay money towards your closing costs. Who is it for? It covers many loan types: conventional loans, FHA, VA loans. It's really for borrowers who qualify but are sensitive to those starting payments and want to buy a house that meets their needs but are uncomfortable with the long-term payments, and they want a way to get started into those payments. It's for a borrower who is optimistic. They can refinance this loan over the next couple of years into a long-term, lower 30-year fixed rate. So how do you negotiate it? When your agent makes the offer, they're going to be asking just for seller-paid closing costs. We're going to take that money and apply it to your temporary interest rate buydown subsidy. The amount that you need really varies based on a number of factors. It's generally going to be somewhere between 2% and 4% of the sales price, but it really varies because the loan amount, the amount of down payment that you have, the type of loan, the long-term interest rate, all of those things factor into how much is needed. So your agent will contact me and I'll calculate that amount so that the agent is asking for the right amount. The key is the seller has to cover all of it So you can't be asking for too little, which is why in this type of situation, it's important for your agent to contact me before you write the offer. I've mentioned subsidy account, and here's what that means. The seller is putting money into an account that the loan servicer is holding on your behalf. That money is used to offset your monthly payments. So if your first year, your monthly payments are reduced by $350 a month with this subsidy account, here's what's happening. You've got a regular payment and they're drawing $350 from that account towards your monthly payment to reduce what that monthly payment is, okay? And then the next year, there's a lower amount that they're taking out of the subsidy account to reduce your monthly payment. If you refinance this loan before the subsidy account is empty, then whatever money is left in that account is your money. It's applied against the principal balance of the loan. That's what makes this such a really a good value. So in summary, the temporary interest rate buydown is not for everybody, but it's for a lot of people. If you are looking for a way to deal with today's higher interest rates, a temporary rate buydown comes with little risk, and for the right program and for the right borrower can be an ideal solution.
Thanks for watching with us today. Please go ahead and subscribe, comment, share this video with your friends, and hit the little bell in the corner for future notifications. Happy 2023.